Hey there, welcome to the mortgage lending in 2019, sponsored by Sandra Price from Employee Solutions Group. My name is Keith Hoffman. I'm with Draper and Kramer Mortgage Corp, and we thought today that we would go through some information for you in regards to what's happening in the mortgage lending industry. Obviously, there are lots and lots of changes, so let's go ahead and get started. So the first thing I want to let you know is what's happening in the housing market itself. So the chief economist of the National Association of Realtors, Lawrence Yun, said he is quoted as saying, home price appreciation will slow down. The days of easy price gains are coming to an end, but prices will continue to rise. And I'll tell you that there's a lot of speculation of where things are going. There's a lot of differences in opinions. The NAR, which is the National Association of Realtors, home prices actually expect things to rise 2.5% in 2019, whereas last year they went up 4.7%. And there's a good reason for that. I think right now you're looking at a lot of first-time home buyers and the qualifications. So when interest rates go up, sometimes people don't qualify for mortgages, and now we've seen some things come down, so the forecast going forward is a little different. Fannie Mae, they're a government-sponsored enterprise. They're the ones that Fannie Mae and Freddie Mac actually guarantee a lot of the most of the conventional loans in the country. Their forecasts for existing home prices are going to rise 4.7% this year. Now, let's take this a little differently. Actually, it's Freddie Mac that was that, and so I made a little mistake here. So it's actually Freddie Mac who suggested 4.7%, while Fannie Mae, their rates fluctuated in it last year, but it actually rose 0.75% to 4.75%. So that's a slight gain, and they're expecting a slight gain in comparison to Fannie Mae or Freddie Mac. Now, the expected 30-year prices are going to be really all over the board. So Freddie Mac expects an increase this year of 0.5% in a mortgage interest rate. The National Association of Realtors expects only 0.4%, and Fannie Mae expects 0.01%. So it's really all over the board where they think interest rates are going. I think right now the thing that's going to really make a difference is the amount of buyers that are out there. And we'll see what happens this year. But with interest rates going up and then coming back down, it's been all over the board. And also regionally, it's been very interesting. Midwest is a lot different than the East and the West when it comes to what's going on here. Now, how do mortgages impact housing? Every day, mortgage rates change. They're like the stock market, and they fluctuate between lending institutions, and it should say banks, not bands. So I'm going to have to go back and change that a little. But they don't think that if interest rates go up a little, that it's going to hurt buyers if they have to spend $75 to $100 more per month. Now, it really depends on the buyer. I mean, if you're a first-time home buyer and you have to spend $75 to $100 more because interest rates went up, that's not going to be a good situation. If you are going to spend $500,000, then you're in a different price range and you're in a different affordability range. So $75 to $100 a month is not going to make that much of a difference to those people. 80% of the growth in home sales in the past 3 years have come from first-time home buyers. And we've seen this a lot, especially here in the Midwest. More and more people can afford homes and therefore have actually driven the prices of homes up in that small price range. Now here in the Chicago area, what we found is that when you find a home that's under $300,000, and you're wanting to buy it, I'm going to suggest that you go in right away and get that under contract because those are the ones that are going very, very quickly. Now, one of the things that we've figured out is whether you're a short-term buyer or a long-term buyer. So if you're going to be in a home for maybe 2 to 3 or 4 years, sometimes it doesn't make sense to buy a home because the prices might fluctuate. You're not going to be able to afford the closing costs when the realtors have to, jump in and sell your house. Some of the tax credits that you're going to give. So a lot of people that are actually buying on a short term from maybe 1 to 3 or 4 years, they're taking adjustable rate mortgages versus a fixed rate mortgage. Now, if you're going to be in your home for a long period of time, it truly is much better to be in a home and get a fixed rate mortgage. It's a much more conservative thing, but the only thing that's going to go up in your payments is when your taxes and insurance goes up. So what we did is I ran some numbers here. In October 2017, adjustable mortgages represented only 5.2% of the mortgages. And 1 year later, which is October of last year, it represented 8.2%. And the reason for that is a lot of these buyers are feeling much more comfortable with a lower payment. And with the structure of rates, going up and down, it just seems like a lot more people have been taking the adjustables because they can save a considerable amount of money. Now, let's look at the adjustable versus the fixed rate. So I just gave you an example here of what you can look at in a dollars and cents savings. So I based this on a $300,000 sales price with 20% down. And the buyer is going to have good credit. So what's going to be dictated to the rates are the the credit scores, as well as your down payment. So for example, today's rate was 4.375 for a 30-year fixed mortgage. And based on that loan amount, you're going to be paying $1,198 a month in your principal and interest payment. Now, if you took a 5-year adjustable, it's fixed for 5 years, and it's going to be fixed at 4.125. So that payment's $1,163 a month. Now, in your mind, you might say, that really doesn't make any difference. I really shouldn't do that. But if you're going to save $35 a month on a 5-year adjustable, and you're not going to be there for 5 years, this definitely would make more sense. You can save $350 a year, and in 5 years, $1,750. So again, if you're a first-time home buyer, this is a great opportunity for you. And again, if you're going to be buying a $300,000 house, you probably are not going to be putting down 20%. But this is an example of how you can save money by doing an adjustable. And when you're looking at this 5-year adjustable, it's fixed for 5 years. And then each year it goes up or down based on the rates. Now, here's an option for you. We're looking at buying a home and putting less than 20% down. Now, it's kind of funny. When I first started buying my house a long time ago, my dad says, you have to put 20% down. Well, you don't have to put 20% down. Here's an example. FHA only requires 3.5% down. When you do a conventional Freddie Mac loan, they have a Home Possible loan that you can put 3% down. Fannie Mae has Home Ready. You can put as little as 3% down. And if you're a vet and you want to take advantage of the veteran loans, the VA loans, you can put no money down. So we try to take care of our veterans, and that's really a special thing for everybody. I think that's really a good thing. And their rates are very, very reasonable in comparison to the conventional loans. Another thing that we can look at is the state-by-state down payment programs. Now, Illinois has Illinois Housing Development Authority, IDA, and we really can loan money through this program. I'll get into that in just a few minutes, but each state has their own down payment assistance program, and it's just state by state. So your lender would have to just double check on that particular situation. Some of them do not require you to be a first-time home buyer. Most of them do when you're getting the down payment assistance program. Now, we're going to look at loan limits. They're different for conventional loans than FHA loans. So in the United States, with the exception of the high cost loan areas like Washington, D.C. and Virginia, parts of that, New York, the loan limit for a conforming loan is $484,350. And when you buy a 2 unit or a 3 unit or a 4 unit, it goes up from there. So you can look at that in comparison to FHA limits. So an FHA single family home, whether it's a condo, townhouse, or a single family home, you can borrow $368,000 in DuPage County. And what I did was I really just tried to show this because we're in the Chicago area, the collaring counties, each county has their own loan limits. So in the Chicago, Naperville, Elgin area, Lake County, Cook County, DuPage, Will, 368,000 for a single family house is what you can borrow on an FHA mortgage. And you can see it goes higher. If you do a 2 unit or a 3 unit or a 4 unit, it goes up from there, obviously, because the pricing of the homes are much more expensive. Now, when you're putting less than 20% down, you're going to have mortgage insurance. And mortgage insurance ensures the lender that you will not go into default. So I just did a little comparison here. When you do a conventional loan, and these are mortgage insurance rates from one of the companies that we use, and for the most part, they're all the same as far as rates go. Some of them differ very, very slightly, but most of them are almost all the same. You can see that if you did a regular conventional Fannie or Freddie loan and you put down 3%, so that's 97% loan to value, you're going to have 35% coverage. And when we go to the right over here, you can see 35% coverage. If you had high scores of 760, you're going to be paying 0.55% per month. And you can see how it goes down. The rate goes up as your scores go down. So if you were in a 640 to 659 range and putting 3% down, you're going to pay 2% every month. And that's a lot. So obviously it's much more important to you to have high credit scores, and you can see how the rates go down. So if it's 95, so if you put 5% down and you have higher scores, 0.41%. If you're putting down 10%, it's 0.3%. So you can save a lot of money by putting more money down. Now, when you're doing one of the Home Ready or the Home Possible loans, you can see that they give you discounted rates. So you only need 30% coverage when you're doing this. And when you're looking at the Home Possible, you're going to only need 25%. So now you can see the difference here where you break it down at 25% versus 35%. You know, you're saving 10% or 20% of that monthly mortgage insurance. Now, FHA has mortgage insurance too. It's called mortgage insurance premium. It's different. They charge 1.75% up front. They add that to your mortgage, and then it's 0.85% per month. So it's a little different, but many times you'll get a lower interest rate on the FHA versus a conventional. So there's advantages and disadvantages for both. You just have to talk to your lender. I always explain it to my customers pretty easily. Now, there are some specialty loans with down payment assistance programs, as I mentioned to you. There's a number of loans that are beneficial to every homeowner, not only first-time home buyers, but you have to meet the criteria of the qualifications that are set forth for each of the programs. So for instance, here is a separate type of a program that's bank statement loans. If you're self-employed, most of the time, you know, your tax returns are going to show lots of deductions. Sometimes you are not paying yourself on a regular basis. So with this particular type of a loan, the bank statement loans, A, you have to be self-employed, and then B, I need 12 months of your bank statements. And what we do is we look at all the deposits that go into your bank statements, and we can use 100% of that. Now, depending on the actual um, loan or bank that's offering this, some of them differ a little, but the ones that we use, or the one that we use, we have 100% of the income that goes in. Sometimes people like to use the bank statements for their business, and so what we do is we'll use 50% of that. But there are types of loans that allow you to do this. Of course, the interest rates are a little higher because they don't conform to Fannie Mae and Freddie Mac guidelines, but it's a great opportunity for you to be able to purchase a home and still meet the guidelines of the product that you're trying to get. Now, there are a number of loans for first-time home buyers, and as I mentioned to you, the down payment assistance. So when I'm looking at all the different types of inexpensive loans, you can do a conventional loan, as I mentioned, with 3% down with Freddie Mac or Fannie Mae. And again, your lender is going to underwrite your loan to that particular product. So you don't have to say, well, I need to go to a Freddie Mac lender or I need to go to a Fannie Mae lender. What you're going to do is you're going to go to a lender that offers all the different underwriting types. FHA, you can put as little as 3.5% down. VA loans, you can put no money down. And USDA loans, or rural housing loans, you don't have to put anything down. Our company offers jumbo mortgages with as little as 5% down. And usually when you do a jumbo mortgage, if you go back to where we were, the $484,350 is that conforming limit. When you go higher than that, you become in a jumbo mortgage. And that is a different class. They have different regulations. They have different credit score requirements. They have different down payment requirements. But in either case, we have lenders that go as little as 5% down. And most jumbo mortgages require a minimum 20. So that's kind of a nice niche product that we offer. If you're going to be a doctor or a physical therapist or a dentist, they have 100% doctor loans with no mortgage insurance. And if you're in the medical field, this is a great opportunity for you to take advantage of that. We offer this in a number of states. We also have some of them that, the doctor loans that you can put 5% down. But aside from no mortgage insurance, they don't have to qualify with the payment on your student loans. And that's a big, big plus, because if you're going to med school and you have $300,000 or $400,000 worth of student loans, you'll find that you really have a big amount of money you have to pay back. And when you look at those and the ratios, they don't have to be included if you're in the doctor loan program. So let's go back to the Illinois Housing Development Authority. They have different mortgages, and these are first-time and non-first-time home buyers. So Illinois does allow that. They allow new construction loans, and they also allow all counties in the state. So some of them, have different regulations and different qualifications, but all of their loans can be done in the state of Illinois. This IDA loan is the Access Forgivable, and I love this because they're going to give you 4% of the purchase price up to $6,000, and you can use that for down payment, closing cost. You can do, you can prepaids, and so anytime you're going to do this, it's given to you, and it's forgiven over a 10-year period. So if you're there for 5 years, you only have to pay back part of it. If you're there for 10 years and you have the same mortgage, you never have to pay that $6,000 back, or 4%, whatever, if it's lower than that. It's a 30-year fixed mortgage, or you can do it on an adjustable mortgage. You can do it on an FHA, a VA, a USD, a Fannie Mae, a USDA, a Fannie Mae, Freddie Mac loan. You can do it in conjunction with any of those. So as long as you have that minimum down payment of 3% or 3.5%, you would qualify for this. And this is great because you bought a home for $100,000. Let's say you bought a condo for $100,000, and they give you 4%. There's $4,000 that they're going to give you. That will probably cover all of your closing costs. Or you can use that for your down payment. So now you have 4% down payment, and you work with your real estate agent to see if the seller will pay closing costs for you. So many times you can walk in with virtually no money out of your pocket. It is available for first-time home buyers, but it also is available for people who have already owned a home before. And that's really important. They've changed that rule. It used to be first-time home buyers only. The second IDA loan is the deferred mortgage, and they're going to give you 5% of the purchase price or $7,500, whichever is lower. And you can use that for the same kind of things. It's a 30-year fixed mortgage, and you can use it in conjunction with anything. This is an interest-free loan, which is awesome. And you don't have to pay it back until you sell your house. So basically, what they're doing is they're giving you the money up front to use, and yet you can give it back to them, and it's not costing you anything to do. That's a great program. The last one is the access, the repayable, and they'll give you up to 10% of the purchase price or $10,000, whichever is lower. Same qualifications, same issue. And this is nice because you're repaying this over a 10-year period, and it's interest-free. So it might be like $42 a month, but that's okay because they're giving you the money. And again, if you sell it within that 10-year time frame, you're going to pay part of that back. But that's pretty acceptable when you're looking at what they're going to give you. I mentioned the physician loans. This is a specialized loan that you have. They'll allow you to go to 50% of your gross income. Now, many people are not going to feel comfortable there, but it is a product that it's acceptable because you're going to use your income. Well, what if you have somebody that lives with you that's going to be paying part of it also? It's possible. So that's something that's really nice. You don't have to count your student loans in there. You don't have to put any money down, and there's no mortgage insurance. So luckily, if you're going to be a physician, if you're going to go into residency or something like that, this is a perfect loan for you. Now, I want to touch bases on credit because credit scoring is really, really important. And it really dictates to all the lenders your risk factor. Are you a good risk or a bad risk when it comes to paying your bills back? So you can see the question mark on the top with the little grid that says your excellent credit is 750 to 850. And there are different categories, and the actual loans are based on whatever your scores are. So the adjustments that you get, if you have worse credit scores, you're going to have higher adjustments, which means higher interest rates. When you look at this, the credit scores vary between each bureau. So TransUnion, for instance, goes between 309 and 839. And they're called FICO scores. They use different models for each of the credit bureaus. So TransUnion uses FICO, where Experian uses FICO 2. And they're going to be changing because they make these changes all the time. They want to make sure that the borrowers are that their scales are correct versus 2 years, 3 years, 4 years ago. Experian goes between 320 and 844, and Equifax ranges from 334 to 818. And their system is called Beacon. Now, obviously, if you have anything over 640, you'll be able to do a decent loan. When you're into the 700s, that really is the place to be, 700s to 800 scores, to get the best rates. Now, people ask me, well, how do I improve my credit, or what's my credit made of? So I broke this down. 35% of your credit is made up of your payment history. On-time payments, or are they late? Are they not late? Do you make your payments on time? The second one is 30% of your credit scores is based on the balances. So if you have a balance of $1,000 and the high limit is $1,050, you're very close to the limit. and that's not a good situation. So your scores are going to be lower. If you have a credit card, let's say with a $5,000 limit, you want to keep it 50% or below that and never go over it, or your scores will temporarily be lower, considerably lower, when you're looking at going over your limits. 15% of your credit history is based on actual history itself. So the longer you have a credit card, the better it is. You're trying to build up a long time frame of good credit. So never, never, never cancel it if you have good credit, because then you're going to kiss that goodbye. It'll be done and it won't be in your history any longer. 10% of the credit is based on credit inquiries. So anybody who runs your credit, if you go to a car dealership, they run your credit because you want to buy a car. If you go to a lender, you want to, get a mortgage, they're going to run your credit. So each one of these things are going to lower your scores temporarily, but you want to keep your inquiries to the minimum. And the last one is the type of credit cards. So each of the models are based on their own algorithms, and they won't really sit there and tell you, well, the perfect scenario would be a house payment, a car payment, 2 store credit cards, a gas card, whatever. It's going to make a difference in the type of cards that you have, whether it's a store card, a gas card, a major Visa or MasterCard, things like that. So that's going to make 10% of the difference. Now, the number one question I've always been asked is, why are my credit scores lower than what I get from the credit bureaus? Or I go to Credit Karma and I see the credit scores are much higher than what we're seeing. And the reason for it is there's different models for each particular business. So the most widely used is the FICO 8. Each one of them have used that, Experian, Equifax, and TransUnion. But if you're a car dealer, they are going to use the FICO 8 or the Auto Score 2. Now, you don't know the difference, but you can see each of the bureaus are going to be using something different. So you can see right here the FICO Auto Score 5 for Equifax, whereas TransUnion uses 4 and Experian uses 2. And that's their own little models. So you're going to have different scores when you look at them if you're going to deal with a car dealership. If you're going to go to get a credit card, you can see their differences. Now, each one of them used the bank score 8s, but they also use the score 3 and the bank score 2 for the Experian. This uses the 5 for Equifax and the 4 for TransUnion. So you can see, oops, let me go back a little. So you can see the differences. And if you're a mortgage lender, we use the FICO 2 for the Experian and the FICO 5 for Equifax, and TransUnion uses score 4. So it's kind of an interesting thing. They're going to come out with these new versions, and I've put that down there, the score 9s, the score, so they're all going to try to be using these new ones, because why would one bureau give you a different score than a different score, bureau does if they're using the same creditors as far as reporting it? So I think that's really important. So don't freak out. Don't go crazy when you're looking at your credit scores. If you're going to go to a mortgage company or a bank for a loan, pick the one that you want to go with and then have them run the credit scores, because you don't want to keep having a lot of people run your credit scores. And again, I've had to explain that. I had a borrower a long time ago that says, well, my scores are whatever they were. And I said, well, the reason for that is because lenders use different models than the raw scores. And obviously you can see why the difference is now. So just keep that in mind. Don't go and get Credit Karma and get your credit scores and think that they're all so high when you're going to either do a credit card application or a mortgage or even a car. Now, credit scores are really important, so I wanted to show you the difference. And I did this because I looked at, and again, these rates are not today, but what I did was I looked at a $300,000 purchase with 10% down. And if your credit scores were 640, your payment was going to be $1470 a month because on that particular day, the interest rate for that program was 5.125. Now, let's compare that to somebody who had higher scores. If you had 740, your payments are going to be $1368 a month. So the adjustments with better scores are going to save you a lot of money. You can see $102 a month on that particular day. It's $1,224 a year. And in 7 years, you can save $8,568. So it's really important to have good credit scores when you're looking at buying a home or even a car. Oh, this is always an interesting thing. Tax benefits for home ownerships. Now, as you all know, our wonderful government changed how we do our taxes this last year. So, without getting politically incorrect, I'm going to let you know that if you itemize your personal deductions, interest that you pay on your mortgage is tax deductible, and I say within limits. Let me preface before I even go any further. You'll want to talk to your tax accountant or your CPA or do your investigation on www.irs.gov and you can get all the details on specifics. I'm just trying here to give you a rough idea of where we're going and what happened this year. So mortgage lenders can charge you a fee and they can charge you points. And typically 1 point is 1% of your loan amount. And that is deductible when you purchase a home. Now, I would talk to your attorney, when you're going to be buying the home and see how they work that. But you as a lender, you as a borrower, will always be able to take that on a purchase. You can't do that on a refinance because you already own the house. So that is a tax deduction you can get. One of the biggest changes that they've done is the federal taxes have limited the tax deduction for your home to $10,000 per year. And that includes the property tax and any other state or local taxes. The other thing you need to know is if you decide to sell your home, you'll be able to deduct taxable capital gains on your home. And of course, this is something you want to talk to your accountant about because there are tax deductions that you can take. There are also one-time exemptions and things like that. But the fees that you can actually take, so let's say you bought your house for $200,000 and you sold it for $300,000. Your gain is not $100,000. Your gain is $100,000 minus the money that you're paying in commissions, minus the title insurance, minus the legal fees, the advertising cost, any administrative cost, escrow fees, inspections, and all kinds of things that that's considered selling cost. So again, that's something you definitely want to talk to your CPA or accountant about. And the other thing is huge. This is for married taxpayers who file jointly. They get a tax-free up to $500,000 in profit on a home used as a principal residence for 2 of the last 5 years. And again, I sold my house. I lived in it 2 of the last 5 years. So I can take that as my exemption. I didn't have to pay the capital gains on that. But again, this is something that you want to talk to your accountant or CPA about in great depth and talk to them early before your planning sessions. Now, one of the things that I've all found is that people love apps on their phone. And one of the best apps that you can find is the one that we offer here at Draper & Kramer Mortgage Corp. So I have one on the right side that you can see. You can see the handheld one that somebody is looking at, and I've co-branded that with another real estate agent. But there's a lot of things that you can do on this, and with the day and age of people not wanting to, go out and look at a million homes without previewing them, you can go online and look at them. You can, through this app, you can do a home search. Now, I'm not a real estate agent, so mine goes through realtor.com, but if you're sitting at home and you decide at 10 o'clock at night, you're kind of bored, you want to look at some homes, you can put the criteria right in, it goes through realtor.com. Now, with my co-branded apps, it goes directly to that real estate agent's website. So you can look at homes through that website for somebody that I refer to you. There's some great things on here. You can share the app, you can do calculations. But when we're doing a loan application, you are able then to take a picture of a document that I need, and it goes directly to my computer via the app. So if I call and say, you know what, we're almost ready to close, the pay stub you gave me is going to expire in the next week, can you get me a new one? You can go and take a picture through the app, and it'll go directly to my computer. I can do lots of things on here as a loan officer, as an originator. I can look at all the loans. I can educate, people. I can go through pre-approvals. Just there's a million things that I can do on it. So it's a great opportunity. So if you really would like to do it, just go to https://mylone.dkmortgage.com/INJBP, and that you can download the app. Now, there's a couple of benefits that I have as a lender. I always, every lender can probably offer you something as a benefit. Not only are they smart and intelligent and able to assist you with a lot of customer service, but our company offers added benefits through Genworth. Genworth is a mortgage insurance company. They used to be GE. And with the program that we have with them, you are allowed to buy things at discounted rates. You just go on to the website. Once you do a mortgage with me, I give you the codes. You go on the website, sign up, and then you can get things like GE appliances or ADT security. You can get Home Depot and things like that. So there's a lot of things that you can take advantage of. Those are automatic discounts. It doesn't cost you anything. And then the other thing, as I mentioned, is my mortgage app, which I've given you that information on. So I've tried to give you a quick overview, 30 minutes worth of what's happening in the mortgage industry in 2019, some of the benefits and things that might help you along. So at this point, I'm going to give you my personal information. You can always reach me by cell at 630-306-5626. My email address is keith.hoffman@dkmortgage.com. We all have great websites. There's a lot of things on my website you can go to is dkmortgage.com/Hoffman. And I am personally licensed in a number of states. Our company is licensed in most every state. So if you're going to be buying or refinancing or doing something out of state, just give me a call. I'll be glad to help you out, and we can go from there. I want to thank Sandra Price for sponsoring us tonight, and really appreciate the opportunity. So if there's anything I can do, please give me a call. Thanks so much. I hope you've enjoyed it.